Welcome to my channel, your ultimate destination for mastering finance and business management. Whether you're looking to grow your wealth, build your business, or sharpen your skills, we've got you covered with practical tips, expert insights, and actionable strategies. Let's embark on the journey to success together. You need a lot of money to start investing. Many people think that investing is only for the wealthy, but that's a myth. Thanks to fractional shares, you can invest in high-priced stocks like Tesla or Amazon with as little as $1. For example, platforms like Robinhood, Sure, and Fidelity allow investors to buy fractions of expensive stocks, meaning you don't need a large sum of money to get started. Even with small investments, you can start building a diverse portfolio and benefit from long-term growth. The key is consistency and leveraging dollar-cost averaging, which means you invest a fixed amount at regular intervals. The stock market is too risky. Yes, the stock market can be volatile in the short term, but over the long term, it has historically provided solid returns. For instance, since its inception, the S&P 500 has averaged around 10% annual returns. The key to mitigating risk is diversification. By investing in a mix of stocks, bonds, and other assets, you can protect your portfolio from major losses. It's also important to adopt a long-term perspective, so you're not unduly affected by short-term market fluctuations. You need to time the market to make money. Trying to time the market is not only incredibly difficult, but it also often leads to missed opportunities. According to research by Vanguard, missing just the 10 best market days over a 20-year period can result in significantly lower returns. Instead of focusing on short-term market movements, it's better to adopt a buy and hold strategy and focus on the long-term growth of your investments. Dollar-cost averaging, where you invest a fixed amount at regular intervals, is an excellent way to avoid market timing pitfalls. Investing is only for the wealthy. Investing is not just for those with deep pockets. In fact, one of the most powerful tools in investing is time, and anyone, regardless of income, can take advantage of it. With low-cost platforms and investment options like index funds and ETFs, anyone can start investing with a small initial investment. The rise of robo-advisors has also made investing accessible, with minimal fees and no need for deep financial knowledge. So don't let your income level stop you from starting your investment journey. You can get rich quick by investing in stocks. Many people believe that the stock market is a quick path to wealth. While it's true that there are stories of investors getting lucky with a stock pick or a timely trade, the reality is that most successful investors accumulate wealth gradually. The stock market is for building long-term wealth, and the best results come from consistent investing, diversified portfolios, and compounding returns. Focus on long-term goals and steady growth rather than trying to get rich quickly. Stock prices always reflect company true value. Stock prices are influenced by a variety of factors, including investor sentiment, market trends, and economic conditions. In some cases, stock prices can be overinflated or undervalued. For example, during the dot-com bubble in the late 90s, many internet stocks were overpriced despite having little revenue or profits. To invest wisely, focus on a company's fundamentals, earnings growth, competitive advantages, and management quality. Don't rely solely on stock prices to determine a company's worth. Stocks only go up over time. While the long-term trend of the stock market has generally been upward, it has also experienced sharp declines during recessions, such as the 2008 financial crisis or the early 2000s dot-com crash. The key is to prepare for market volatility and not panic during market dips. Diversification can help you navigate these downturns by spreading your risk across various sectors and asset classes. And remember, the market always recovers over time, rewarding those who stay patient and focused on the long term. You should always invest in popular stocks. Many investors gravitate towards popular stocks like Apple, Microsoft, or Amazon because they're well known. However, just because a stock is popular doesn't mean it's the best investment. These stocks are often priced at a premium due to market hype. It's important to diversify and consider other growth opportunities outside of the mainstream stocks. Small cap stocks, international stocks, or ETFs can offer more attractive growth prospects and lower entry prices. Diversifying reduces the risk of overexposure to any one company. Investing in individual stocks is better than mutual funds. While individual stocks can provide higher returns, they also come with higher risks, especially if you're not well versed in analyzing companies. Mutual funds, on the other hand, offer instant diversification and are often managed by professional fund managers. They allow investors to gain exposure to a wide range of stocks, reducing the risk associated with individual investments. If you're just starting out or prefer a hands-off approach, mutual funds and ETFs are a great way to build wealth without the complexity of stock picking. You have to be an expert to invest. Investing doesn't require an expert-level understanding of financial markets. With the abundance of resources available today, whether through books, blogs, podcasts, or online courses, anyone can learn the basics. Additionally, robo-advisors like Betterment and Wealthfront allow beginners to invest without needing to be financial experts. These platforms help tailor your portfolio to match your risk tolerance and long-term goals, making investing accessible for everyone. Bonds are always safer than stocks. Bonds are often considered a safer investment than stocks, but that's not always true. While bonds tend to be less volatile than stocks, they carry risks like interest rate risk, credit risk, and inflation risk. In a rising interest rate environment, bond prices tend to fall, which can erode your investment's value. In addition, low-yield bonds may not keep up with inflation, ultimately diminishing the purchasing power of your returns. It's important to balance bonds with stocks for growth and stability in your portfolio. You can only make money in bull market. Many people think that you can only make money when the stock market is rising. However, there are several ways to profit during a bear market as well. Thank you for watching Sapric Your Finance. If you found this video helpful, don't forget to like, share, and subscribe. Hit the bell icon so you never miss our latest insights on finance and business management.